Today's episode is brought to you by MetaMask Portfolio. You'll be hearing more about them later on, but for now, let's get into today's interview. Very happy to welcome to Forward Guidance Althea Spinozzi, Senior Fixed Income Strategist at Saxo Bank. Althea, welcome to Forward Guidance. How are you doing?
Very good, Jack. Thank you for having me here.
Thank you for joining us. So let's stick in my neck of the woods, U.S. rates. The long duration treasuries have been in a brutal bear market that many thought was over after the brutal bear market in 2022. This summer and late fall, the pain has continued. However, over the past 48 hours, there's been a renewed rally in the long end based on the U.S. Treasury making a certain announcement. So overall, let's start. What is your view on duration now? Are bonds, attractive?
Well, Jack, I've been a bond bear for a couple of years now, and I'm still struggling in taking duration risk. And with duration risk, I'm talking more about the ultra long maturities in the yield curve, so 20-year plus, the famous, for example, TLT that I'm sure that you have discussed a lot about. And the reason behind that is that we might not have seen the end of the bear market in the long part of the yield curve. Yesterday, two crucial things happened in the United States. We had a quarterly refunding announcement, and we had the FOMC meeting. Following this announcement, we had the yield curve bull steepening. So we have seen 10-year yields going from 4.95% to now 4.65%, around 30 basis points lower. And today, people really think that the duration trade is a good trade. But I still think that it's not the time yet to pick up that bet. The reason is very simple. There is a lot of selling pressure. You see, let's start from yesterday, the quarterly refunding announcement. So yesterday, 10-year US Treasury yields dropped by 20 basis points in one day. 15 basis points of those 20 came before the FOMC meeting. And it was due to weaker ISM readings, of course, but also and especially because the quarterly refunding announcement showed that the U.S. Treasuries next week is going to sell $112 billion worth in T-bills and coupon notes against the 114 that the market was expecting. So that has lowered the term premium because less issuance means somewhat tighter demand and supply, and that should be constructive for risk. And that's why we have seen yields dropping before the FOMC meeting. But the big problem with that is that next week, the kind of sizes that the US Treasury is going to sell on 10 years and 30-year notes are massive. And they are similar to what we have seen during the COVID pandemic. The US Treasury is selling 40 billion notes, 10 years notes, and I believe it was around 24 billion 30 years bonds. If we look at pre-COVID, so let's say the 10 years between 2010 and 2020, the average size, auction size of 10 years notes was 22 billion. So almost half what the US Treasury is selling next week, and roughly around $14 billion in 30-year US treasuries. So we have seen a pickup of almost 60-70% in terms of sizes. But the main difference is that before COVID and also during COVID, we had quantitative easing. Now we don't have quantitative easing. We have quantitative tightening. The Federal Reserve is a net seller of these issuances. US banks are not there either to buy these kind of issuances because they bought US Treasuries at 4.2%, and now they don't have any more that buffer to add on to their duration. And foreigner buyers, and I'm talking especially about Japanese investors, which hold around 15 percent of the U.S. Treasuries outstanding, they are repatriating home. Because why? Because right now, Japanese investors buying U.S. Treasuries at 4.6% will need to lock in a minus 1% yield once they hedge currency risk. Everything is telling me that the bond bear market is not done. And maybe we are seeing a rally this week on the back of, like better expectations in terms of supply. But still, it's very important to say that the US Treasuries announced that also next quarter they're going to increase coupon supply because they have a bigger fiscal spending that they have to finance. And so at this point in time, it's very hard to see that trade performing. And Jack, I want to make a practical example, right? There is obviously, we have a lot of US Treasury issuance, but if we take the ones that they bear a very low coupon, for example, the ones that they have been issued during the 2020 COVID pandemic, we can find US Treasuries with a maturity to 2050 paying slightly over 1% coupon. These issuances have been falling to 40 cents on the dollars. And a lot of people have been buying them because they're saying, like, this is cheap. Buying US Treasuries at 40 cents on the dollars is almost a distressed case, right? But the problem with that kind of trade is that if you buy now and this trade gets against you, right? Because the duration, it's massive on these kind of bonds, you are not going to be able to do anything with this kind of issuance. You just have to pray that at a certain point, the Federal Reserve is going to cut rates fast enough and revert to what we have, to the kind of levels that we have seen more or less during the COVID pandemic or just before the COVID pandemic. And right now, with inflation running double the Federal Reserve target, that's unfeasible. So it means that investment might be worthless in the next few months or year. And there is much better opportunities out there. So when I look at US Treasuries, not only also corporate investment grade bonds, there is bonds with 10 to 15 years maturities that they provide a coupon between 6 and 7%. They still give investors some sort of duration risk, and not as excessively as that US Treasuries 2050 with 1% coupon, but they still do. And they pay a coupon that is quite sizable. And that implies that if that trade goes against you, investor can still sit on that, receive 6 to 7% per year in coupon, and wait for that kind of scenario. So the Federal Reserve aggressively cutting rates to materialize. But until that doesn't happen, it doesn't make sense to amass on high modified duration bonds.
Let's just hone in on the demand points. We've got foreign buyers who sometimes they want the dollar risk, other times they need to hedge that risk. You've got the private banking system who bought a lot of treasuries in 2020 and 2021, and they're somewhat non-economic buyers. You've got the hedge community, levered investment. You've got the Fed. They're not there anymore. They're net sellers. They're rolling off their balance sheets. Who is going to be the marginal buyer of treasuries? And at what point do you think okay, there's so much bad news, but that bad news is priced in that 10-year note, that is so high.
Yeah, I think that point is going to arrive when there is a clear understanding that inflation is under control and is going to revert to the 2% target. Right now, like I said before, we are still double the Federal Reserve target, and there is a lot of things happening, geopolitical risk. We were talking about the war in Ukraine, 1 year ago, and now we're talking about a war in Israel while the war in Ukraine is still going. And a war means, after all, more fiscal spending and therefore more US Treasury issuance. A war means some sort of inflationary kind of push uh, because that is a critical area for the passage of commodities. And therefore, if something happens over there, we cannot exclude that commodity prices will start to increase. We have seen already oil going from 80 to 90, right? So definitely that can be a resurgence. What really, I need these things to be fixed. Another thing that we would need to have fixed is the demand, right? Because I said the Federal Reserve, U.S. commercial banks, they were somewhat price insensitive buyers of U.S. Treasuries. What we are left with, we are real money. We have pension funds, asset management, we have investors that are buying US Treasuries, and all these players, they are price sensitive players, and they want to see a fair price on their US Treasury bonds. So next week, a refunding of 10 years and 30 years bonds, we are going to see that players that need to secure a yield for these kind of issuances. And it will be interesting to see if they want to have the 10-year US Treasuries at 4.6% instead of close to 5. And the reason for that is that yesterday at the FOMC meeting, yes, it sounded dovish, but what Powell said is that they might not hike only on the basis of long-term yields to remain high. So he was talking about yields around 5%. Now they are much lower. And if they stay that low, they need to do something. It might not be interest rate hikes. They still have quantitative tightening. And they might want to re-steepen that yield curve. And even if they don't want to re-steepen that yield curve, the kind of movement in place that was in the past few weeks is going to resume and continue. You see, Jack, I think that I read a lot of news between yesterday and today, and almost everybody was talking about the fact that now the market is positioning for rate cuts. That's not true. The 2-year US Treasuries is still trading around 5%. Yes, it fell to 4.9%, but if you look at it in a graph, it has been around 5% for the last 3 months. So that has not been a massive repricement. And when I look at the 3-month SOFR curve, I still see the expectations from markets that interest rates are not going to fall below 4%. And therefore, if interest rates in the long run, in the next 10 years, are not going to fall below 4%, the 10-year US Treasuries has to reprice above this level. And historically, the 10 years US Treasury was pricing between 100 and 150 basis points over the Fed fund rate. So that means that the fair value on 10-year US Treasuries is around 5 and 5.5%. We need bond future to drop much further and to show maybe that interest rates in the next 10 years are going to drop to 3% or lower in order to have 10 years yields trading more or less where they are now.
Today's interview is brought to you by MetaMask Portfolio, your one-stop shop to manage your crypto assets and access a range of Web3 services all in one place. Overseeing your crypto assets across different wallets and networks can be very complicated. MetaMask Portfolio solves this by giving you the reins to manage your crypto from a single decentralized application, or dapp. Just connect to MetaMask Portfolio to get a bird's eye view of all your coins, tokens, and NFTs, and you can easily buy, sell, swap, bridge, and stake crypto assets at competitive rates right within the app from a vetted list of providers. No more jumping between dozens of sites and apps. MetaMask Portfolio lets you do more in Web3 your way, giving you secure and convenient access to a wide range of features and services all in one place. Manage your portfolio your way with MetaMask Portfolio. Click the link in the description of today's episode to get started. Thanks, let's get back to the interview. Could you speak a little bit about the foreign demand for US Treasuries, Europe and Japan mainly? One might think, oh, Japanese investors, they can buy a 10-year Japanese government bond, JGB, at less than 1%, or they can get that nice, juicy, 4.6% yield on the 10-year Treasury. It's a bargain. Tell us why it's a little bit more complicated than that regarding the hedging cost of hedging, dollars into yen, and why actually, if you take into account that, it actually might not be attractive. It might be very unattractive for Japanese investors to buy Treasuries.
Absolutely. So the way it works is that foreign investors typically hedge against their currency risk on a 3 months forward. So that position needs to continuously to be rolled. And right now, what that this hedging cost is showing is that investors will have to deal with a yield on 10-year US Treasuries of minus 1%. It's similar for euro investors. There is a catch though, Jack. When we look at the Bank of Japan, and everybody talks about yields rising in Japan, of course, if you want to invest into long-term sovereign bonds, it makes sense that Japanese investors invest at home at 0.9% rather than minus 1% in the US. But there is the expectations of 10 years JGB, Japanese government bonds, yields to continue to rise and to break above 1%. So if that's the expectations, what we are expecting there is a bear market. So what I'm trying to get to is that the dynamic is not that straightforward. As we are seeing yields rising in Japan, the Japanese JGBs will get more attractive, but while they rise, demand will still not be there. It will take a while to play out. So, and that's quite telling because in the past month, we have seen some sort of demand drop from indirect bidders, which, are normally foreign investors. But the drop has not been substantial. And probably the reason for that is that there was the expectations that yields in Japan will move or are moving much higher in the midterm. So this is all about timing. It means that maybe that kind of drop in indirect bidders is going to come at a later point. And we expect the Bank of Japan to normalize monetary policies throughout 2024. It's not going to be one meeting task. Is going to take a lot of adjustments because they are normally very cautious. But while they do that, they will gradually decrease the demand for US Treasuries and also European sovereigns.
Do you forecast a scenario where the hedging costs of converting dollar risk back into the Japanese yen might decline? You said a hedged pickup for a Japanese investor of US Treasuries is not 4.6%, it's negative 1%. Why is it so expensive? Does it have something to do with the yield curve? And might that change where actually, finally, Treasuries are attractive to Japanese investors because the hedging costs have gone down? Because I know there have been times in the past when Treasury yields were much, much lower, when Japanese investors, it was actually very attractive for them to buy, right?
It's all about interest rate differentials, right? And And that's why it's expensive now, because in the US, there is a huge difference in yield compared to Japan. And the same, it's in Europe. So it all comes down to that. There is nothing really that the US Treasury can do about that. What the US Treasury can do, or the Federal Reserve can do, is try to resume quantitative easing, which is quite of far-fetched. Like if they really wanted to boost the demand for US Treasuries, they can do that, and that would suppress yields. But there is no willingness to do that in the foreseeable future, because inflation is still double as much. Or otherwise, they have to try to get into some unconventional ways. But I think it's very important to understand that the situation we are in now is because of fiscal spending. We have fiscal spending has been the reason why the Federal Reserve has been able to hike by 500 basis points, and nothing is broken yet. Like I don't see anybody screaming in the stock market yet. So and that has been all because of these huge programs that the U.S. government have been applying, and realistically, that's not going to change in the foreseeable future. In 2024, we have a U.S. election. There is a lot on the table. The politicians, obviously, if we are starting to see a slowdown of the economy, will try to steer money selectively in order to help certain sectors of the economy. And realistically, there is not going to be austerity until interest rates are going to be so high that that's going to be a problem to raise that. It's going to be a huge problem. This as fiscal spending is not going to go away that easily. And that supports the economy and ultimately supports yields, higher yield.
But it is that shape of the yield curve. It's in interest differentials, but also that shape of the yield curve that is why the hedging cost is so expensive. In other words, if the yield curve was more upward sloping, would the hedging cost be lower and it might be more attractive for Japanese investors?
It should be, definitely, because then the front part will be cheaper, right? It will in terms of borrowing money.
That makes sense, because a Japanese investor buying a 10-year, they're buying a duration instrument on the long end, and they're funding it with short term. So it's the same way a leveraged investor now, borrowing overnight money to buy a 10-year, it's just very unattractive.
There is a point that you're raising there that is quite important: the shape of the yield curve, right? If we have expectations, like there is a lot of people out there saying, oh, yes, the Federal Reserve now is dovish. Let's buy risk. Let's buy bond. Let's buy long-term bonds. Let's buy the Standard & Poor and stocks, whatever we want, right? But realistically, if we have the expectations that the Federal Reserve is done with the hiking cycle, and therefore it will start to cut rates, that would imply that the yield curve would steepen. And how investors would position for that? They would buy the front part and they would sell the long part, regardless of how the steepening is. Bearish, bullish, it doesn't matter. So what does that do? It puts even more pressure on the long part of the yield curve.
When the 2-year goes down, it is likely that the 10-year, the 30-year will go down, but just not as much. So that will be a bull steepener. In history, there are times when the short end goes down, the long end goes up. That can be pretty, topsy-turvy and wild. But you're saying risk adjusted, the 2-year would go down. And now people say, oh, but you want that duration exposure. So buy the 30-year on an unlevered basis. And if you're for an unlevered basis, that's that's where the most juice is, the duration. But you would say, no, you would just want to do a levered 2-year thing. Okay, so earlier you referenced quantitative easing. Most of the Fed's quantitative easing was before they hiked rates. But you say it's there's so much collateral that is owned by the Federal Reserve, and now it's reducing its balance sheet via quantitative tightening. Do you think that the Federal Reserve will return to quantitative easing? Is quantitative tightening sustainable? Can there be a bid for Treasuries, with the central bank not buying?
I think right now it seems that quantitative tightening is sustainable. And Jack, it's very important to understand that now the US, the Federal Reserve is not actively selling bonds on its balance sheet. It's just letting run off some of the maturities, around 95 billion per month. So it's not really an active reduction of the balance sheet. It's not as aggressive. Um, Before they go and they look at quantitative easing, they will probably tweak this kind of runoff if they want, if they need to, or otherwise, if they see the yield curve to all flatten, as we have seen in these days, and therefore, I don't know, the 10 years go back to 4%, and that's not restrictive enough because inflation continue to be sustained, then they can increase the runoff amount or actively sell the securities under their balance sheet. So it's a very powerful kind of tool. And so far, it has not really used to its force. Right now, what really central banks, especially the Federal Reserve, has been doing is just hiking in the front end aggressively and hoping for inflation to adjust lower. And by doing that, it put a lot of pressure on those cash strapped kind of corporates, corporates that have maturities coming due soon, which are very little at this point because the wall of maturities is starting again in the second half of 2024 for the high yield space. It gave a kind of advantage for risky assets that are pricing on the long part of the yield curve. You have companies like Apple that they can basically issue debt, 10 years debt at around, I don't know now, but 4%, 4.5%, and invest in the front end at the 3 months T-bills is at 5.3%.
And would they have sold that bond the 4% yield this year or in 2020? In 2021, when they issued a long term bond yielding 4%, would that have been this? I mean, in example, would that have been this year or in 2020?
Referring to now, right? Like Apple will be pricing more or less where the US 10-year Treasury is, so around 4.6%.
Mm-hmm.
Will be able to raise that money and then invest it. This is not how they operate, obviously, but they can invest it short term at a much better rate. This is the take. But all other businesses are not able to do that. A lot of the other corporates are not able to do that. But it's just like quite telling how the shape of the yield curve can still provoke, like a buoyant market, like a rally in risky assets. And that's exactly what we have seen throughout this year. It is when the yield curve steepens, especially bear steepens, as we have seen also lately, that we start to have problem. And probably that's why we have seen central banks to start to become a little bit more cautious in that sense. But Jack, there is no danger, at least I don't see danger for the Federal Reserve to cut anytime soon. Right now, the bond market expects interest rate cut to begin in June next year. If the economy continues to strive, that might still be a little bit too early if inflation doesn't decelerates to the pace that the Federal Reserve expects. The first central bank that is going to cut rates is going to definitely be the ECB. And here in Europe, we have a recession. There is Germany that is in a recession, the Netherlands in a recession, Italy entering in a recession. And we have the BTP Bund spread now is a little bit off 200 basis points, but is still in an alarming level. And the inflation is not where the ECB wants it to be. And that's a huge problem. This kind of line of thought connects very well to what we have seen in the 70s and in the 80s. So we believe that we are living through a stagflationary kind of environment here in Europe and also in the UK. We believe that we are going to see stagflation in the US as well at the beginning of next year. And what it is, stagflation. Stagflation can be measured as a period of time where there is a sluggish growth or a recession. There is high inflation and high unemployment. And that brings us back in the 70s, early 90s. And in that periods, what we have seen is several waves of stagflation. And those several waves of stagflation, would they really produce higher 10-year US Treasury yields? So if that's what we are seeing today, there is that tail risk that instead of seeing yields dropping, yields might continue to rise until inflation is under control.
And so to clarify, earlier you said quantitative tightening is sustainable or is not sustainable?
Sorry. Yes, I believe that is sustainable in the short term, in the midterm, until something breaks. But then when something breaks, it can be smartly used to give a signal that the Federal Reserve is there to support the economy. And even if they don't do much, even though the Federal Reserve doesn't actively engage into quantitative easing, but it just adjusts the amount of bonds that is letting run off, then that could be still a bullish sign that could give like a constructive sign to the market. But let's not forget that the reason why the Federal Reserve is engaging in quantitative tightening is that it's forecasting that possibly there is going to be another downturn and they need the balance sheet. They need to increase that balance sheet. So that's why they are decreasing it now. And it would be very wrong to put a stop because the balance sheet is huge. It's just off just below 7 trillion. And at its peak, it hit $8 trillion. So it definitely needs a reduction, and I really hope for that quantitative tightening to continue or even accelerate at a certain point.
Right, and that the maximum limit of how much can roll off is 95 billion, but because some of it's mortgage-backed securities and the prepayment rates have collapsed, not a lot of those mortgage-backed securities are rolling off. That's also a point. Like Apple, many American homeowners borrowed at 3% got a mortgage, and now they're getting 5.5% on their cash. Maybe that's one reason the U.S. is not in a recession. Very interesting, Althea. You say that some of Europe is already in a recession or entering a recession. Is that why the rise in European bond markets, bond yields, I should say, has been more muted? In other words, the sell-off in European rates has been more mild than American rates. Do you attribute that to the ECB and supply dynamics, or is it mainly because the economy is much, much worse and bonds tend to rally or do well or do less bad when there's a recession?
Probably because of the latter, because the economy is in a worse shape than the US. And realistically, there is that understanding that the ECB would not be able to do too much because there is a lot of differences between European countries in terms of cost of funding. And here I'm talking about sovereign spreads. The most known and popular sovereign spread out there is the BTP Bund spread, which is Italy 10 years yields minus 10-year German yields. And that has been quite a reference because if we look at historically from 2010 until today, whenever that spread was breaking above 200 basis points, and now it's at 190 basis points, well, the ECB started to be alarmed and they started to intervene when we had periods of that spread around 250 basis points. So the big point here, Jack, is that if we see a recession deepening in Europe, a stagflation deepening in Europe, it's almost impossible to expect that spread to be stable. It's actually more plausible for that spread to continue to widen. And that's going to be a problem for the ECB. And it's going to be even a bigger problem if that spread widens all of a sudden in the next few months when inflation is still well above target. Because at that point, what the ECB can do, it can either maintain hawkish, right, remain where it is, or hike further, and that's going to be supportive for the euro, but negative for the BTP, for the sovereign spreads in the euro area. Or otherwise, it goes to intervene on the BTP bund spread at the cost of the euro. And the thing is that it sounds like a no-brainer, but we have to believe that a wider BTP bund spread or other wider sovereign spreads in the European space, it's a political problem. It's a political problem because for the ECB, why the ECB would want wider spreads in specific countries of the ECB, of the European Union, right? It would want to tighten financial conditions equally all around the European space because everybody is basically using the euro currency. But there's also a political problem domestically for Italy and for other countries that would see that spread widening because they will be like, hey, we are not here paying at the cost of, other countries that have, like they can finance themselves at half of the rates that we see here. So it's a huge problem, and it brings a lot of questions in terms of political stability as well.
Absolutely. An analogy: if the euro, if the United States were not one nation, but it was a union, like the European Union is, it would be like if the Federal Reserve was, buying Texas municipal debt, and in order to narrow the spread between Texas and California spread, or between California and Texas. So that just for our American audience, that's a potential analogy. And then the European Central Bank, ECB, for a while was doing quantitative easing, or they're doing quantitative tightening now, but they're also doing spread control. So they're targeting that spread between the BTP Italian bonds and German bunds. And yeah, how's that playing out?
So they are not really targeting. It's not like some sort of, like range bound that like Bank of Japan, yield curve control. What they do is that they are doing quantitative tightening under one of the programs of the ECB, which is the APP program, which is the asset purchase program. But they left intact the PEP program, the Pandemic Emergency Purchase Program. The PEP program was started in 2020, and it was aimed at helping those countries that were worse hit by the pandemic. So therefore, in that case, Italy, right? Like they purchased a huge amounts of BTPs. If they haven't done quantitative tightening on that program, because they know that once that they go to touch that program, that would be bearish for Italian BTPs, and they don't want to do that. And they kept it intact. They continually invest. But there is also some other ways to look at that. When you look at the PEP program, the average weighted maturity is around 7 years. So it means that even if they would start to do quantitative tightening, they wouldn't have enough redemptions actually to lower the balance sheet, because they are going to be like a few years away. So there is also not much reason to start that now.
Okay, so you said the ECB could turn dovish to protect that BTP spread to narrow it.
Yeah.
But that would come at the expense of the euro. Tell me, are you talking about balance sheet policy, QE, QT, spread control, or rates? Because there's a potential they could keep rates high, relatively high where they are now, 4.5%, but target that spread and really, police that spread to make sure that Italian bonds don't sell off drastically. In the same way, maybe, when Silicon Valley Bank failed, the Federal Reserve initiated this policy, Bank Term Funding Program, and because of that, they didn't need to cut rates. They could actually keep on hiking rates. So, the idea that balance sheet policy and interest rate policy sometimes can go in different directions to maintain an overall stance.
in that case, it's much harder to do, in the meaning that you see, like when it's impossible to compare the European sovereign space with the US sovereign space, because in Europe there is not a very liquid issuance of European bonds. Every country issue their own bonds. So we are talking about German bonds. That's the reference normally. When you talk about European cost of funding, you talk about the German bonds. And then you have obviously Italian BTPs, French OATs, Spanish bonos, and so forth. So when the ECB hikes and cuts rates and create this program, it has to do it in a fairly way. And historically, it never really tackled especially BTP bund spreads. It basically did it implicitly by creating these sort of programs, APP and the PEP program. When I talk about it has to choose between the BTP bund spreads and the euro, it means that inflation is still high, and if they choose to basically go and help growth in Europe and try to create a buffer and maintain that spread stable, then what would happen that they cannot really hike or tighten financial conditions further, and the euro then will fall, because compared to the dollar, our expectations is for the Federal Reserve to stay on hold and to remain more or less where they are. With a lower euro currency, they might be at risk to bringing back inflation. And that's the critical point. And that's the mistake also that we have seen in the 70s. That basically central banks thought that inflation was done, it was over, and they started to see how they could normalize the economy, and then it rebounded again. And that might be the same risk that Europe is running at this moment. And we are talking about countries, the European Union, that is much dependent on commodity prices, and it's buying all the commodities are trading in US dollars and not in euro. So the euro currency is key.
Right. And how does all of that, which you just explained, how does that impact European investors' demand for US treasuries? We talked about Japanese investors for US dollar treasuries. What about how are European investors thinking about allocating to buying US duration that is denominated in dollars?
Well, the thing is that European investors have a lot of opportunities here in Europe. You see, if we look also at the 10-year bonds, it was trading negative for quite a bit, and now it's around 3%. And also, there is a lot of scarcity of collateral. The German government cannot issue enough bonds for how much is the demand out there. So, European investors, yes, they buy US treasuries. Now it's not convenient for them because of that interest rates discrepancy, like exactly what's happening with Japanese investors. But they have quite a broad, they have quite a wide range of opportunities. And here, Jack, I really think it's key to talk also about the corporate space, because we had a sensible repricing here in Europe that didn't happen in the US yet. And I'm talking about junk versus investment grade corporate bonds. When I look at junk in the US, they offer 3 percentage points above investment grade corporates in the US. So investment grade corporates trade around 6%, and that's an average in yield. The average yield of US junk bonds is around 9%, just 300 basis points. And 300 basis points is where they were trading before COVID. But at that point, interest rates were half what they are now in the US. When I look instead at Europe, the junk to investment grade spread is around 500 basis points. So they pay 5 full percentage point over investment grade corporate bonds. And in Europe, junk corporate bonds are not as leveraged as in the US, and they have better fundamentals. So everything comes back to this risk, to this because also duration is part of risk and so forth. It brings back to the fact that what we see happening in the US is not normal. It needs a repricing somehow. Risk needs to be repriced, and it's going to happen because credit is not at a fair price compared to the risk that we are heading towards. And I'm talking about that wall of maturities that it's happening next year. At that point, it's key to see if these junk issuers are going to be able to refinance their debt at current interest rates.
Althea, we're going to wrap it up soon. But my final question for you is: you've been bearish on bonds. That's work. Bonds have sold off dramatically. You remain bearish. A lot of people who have been right, they've changed their mind. They said, actually, now that the 10 years close to 5%, I'm no longer bearish, or I'm neutral, or I may even be bullish. You're doubling down. You say, I'm still bearish. What would it take for you to stop being bearish on bonds?
But Jack, I have to correct you there. I'm bearish ultra long maturities, so 20 years plus. The 10 years actually I think is a good buy. And the reason for that is that at the yield that is offering now around the 4.65%, it can provide upside in case we have a recession. But in case we don't if we have yields rising further, let's say towards 6%, the kind of loss that one will have to incur will be minimal. Because if you look at a 1 year holding period, if yields move by 100 basis points higher, then the loss will be around, the total return will be around minus 2%. So the 10 years is a good buy. And I think that what is interesting now is to build a barbell in a portfolio. So buying the front part of the yield curve, which is basically almost risk-free. You need the interest rates to be hiked by 200 basis points to start to lose money on 1 year holding period, and the 10 years. But still, if you look at longer maturities, my recommendation, it will be to look at those securities that offer a sizable coupon, so that you will still get that duration bet that many are after. But in case it doesn't get your way in the shorter term, you will still be able to benefit from a high coupon.
Got it. So what you remain bearish on is that ultra duration long end of the yield curve. So I take it you're not bullish on the Austrian 100-year bond?
No, absolutely not. I mean, it's tempting. It's trading around 35 cents on the dollar. It's absolutely beautiful. But I feel like when I look at it like that, it looks like a directional bet. And it's a directional bet on interest rates. And we are not there. We are arriving there. But I think that it's something to look at more towards the end of the year. So December or the beginning of 2024.
Got it. And I'm just looking at the spread between 30-year treasuries and 10-year treasuries. Now it's not that high, but if it returned to something like 100 basis points, you might get a little less bearish on it, I imagine.
Absolutely. The higher the yield, the more attractive bonds are. But I want to keep flexible in case there is that tail event, that inflation is not won over yet. And we might have central banks staying hawkish for longer.
There we go. Well, Althea, thank you so much for joining us. People can follow your work on Twitter at Althea Spinozzi. And thanks so much. Thanks, everyone, for watching.
Thank you, Jack.